Hi, how's everybody doing? My first action was to take a multi-week break from Twitter, quite frankly. And then 24 hours later, here I am doing a YouTube. So why am I doing the YouTube? Honestly, I wouldn't have done it, I don't think, to just say what went wrong, though that's a good enough reason to do it. I'm doing it because I think that the stock's incredibly interesting here. And I wanted to share why, but we'll get to that. The last 5 days have been pretty incredible for me, just not to get too personal, but I was in the hospital on Thursday because I thought I was having a heart attack, and I was there all day. And they don't think it's a heart attack. They're pretty sure it wasn't a heart attack. They don't really know what it was. It's possible it was just a panic attack. But that was Thursday. That was all day Thursday. Then this happens yesterday. And for those of you that don't follow me on Twitter, I saw this news an hour before the market closed, but I did not know that this was a facility owned by Target Hospitality. I thought this was owned by somebody else. And because the stock wasn't moving much, I saw huge puts go off in it. Didn't know why. And then I proceeded to buy stock. I already had like a 30-something% delta adjusted position. I bought stock all the way to the close, only finding out within a minute or two of the close happening that this was Target's facility, and it's the most beds they have in any one single facility. I then immediately knew I was fucked. Did not sell any stock in the after hours, but didn't come close to thinking about buying anymore. I proceeded to watch it fall from 1050 to, 750 in the after hours. If that's not bad enough, the move in Target put my Interactive Brokers account at a negative deficit for the first time in 14 years. I've come close to margin calls before, but I've never actually had a margin call before. And sure enough, I had a significant negative equity in the after hours and this morning. I knew how I could rectify it, but Interactive Brokers only gives you 10 minutes to do that when the market opens. So I called Interactive Brokers and I asked for the day, and they told me they'd give me 30 minutes. So I had 30 minutes this morning to get myself from a negative equity to a positive equity. And I did that. It was mostly through cheating. I had to buy out of the money puts in a variety of names for like a nickel that de-risk the position. So then I now have, multiple weeks to very slowly sell what would be, just a few percent of volume a day in some of my names. And I'm already largely done doing that already at 9:30. So I'm no longer in a margin call, and I have significant equity now to invest. And what did I do with that? I basically doubled my common position in Target Hospitality. That's now a it's a 30% position again. Virtually all common with some spreads. I put in a little more spreads today. Why do I tell you all this? So I tell you all this because one, I've always been clear that I use leverage. And two, now you can see what the side effects are of using leverage. Should be a secret that if I have a stock fall, I'm down about 18% today. That's going to be ramifications to my portfolio when that happens. So, yeah, it's been a hell of a 5 days. What happened with Target Hospitality? So, I mean, to say that this was a black swan, is an understatement to swans. That doesn't make any sense. But let's discuss this in detail. So they have a facility that they have owned since 2014, and they lease it to a prison operator, basically, that runs the facility for them. And that facility is called the Dilley facility. And Biden announced yesterday, or his administration yesterday, he was shutting this facility down so that they can raise money to implement Biden's new executive order, which is to basically deport people. And based on Congress being shut down effectively, there's no new funds to house the deportations that are going to be happening under his executive order. So the only way they can implement his executive order is by reshuffling funds that already exist. And they've decided that this facility is too expensive and doesn't meet the same needs that what Biden needs to happen in order to implement these deportations. So what is the Dilley facility? It used to be a facility for families and minors. And in 2021, Biden released all the families with, I guess, ankle bracelets, things like that. So there was no more need to have a facility for families and minors. They turned it into a facility for adults. So it's this sprawling facility with soccer fields and things like that, meant for families and kids, that's housing single adults. This is not, I repeat, this is not what the other main facility that Target Hospitality provides for the government in Pecos. Pecos is the facility and the Pecos properties that they renewed in the fourth quarter of last year that houses children, houses children that are unaccompanied minors. And it's government law that they need to be taken care of until they're 18 years old. And if you go through the details of the law and of the contract with that facility, it is extraordinarily unlikely that what happened here will happen there. It's a complete one-off what Biden did, and it had nothing to do with the larger goal of trying to handle the humanitarian disaster that is at the southern border. He was merely shifting funds because he had to do it in order to implement his executive order. I'm jumping all over the place, but importantly, and this is really important, that facility, the Dilley facility, still has utility for families and children, except right now, there's no families and children being kept because of the Biden administration. If there was a Trump administration, which I would not want, not that my politics matter, he would have a reason to convert this back into a family facility. All that being said, there's currently a third contract out for bid that's similar to the Pecos facility bid that is going to be awarded sometime later this year. And that contract, since it's for unaccompanied minors, my guess would fit in perfectly with this with this Dilley facility. And they would be able to plug and play it basically right back into the system for a different contract for a different purpose, recapturing all and more of the EBITDA they lost from this action. They just won the previous bid, and they have a great relationship with the government that puts out these bids. So it's likely that they are the ones that are going to win the next bid. And this is part of the reason why the private equity firm wanted to buy them. Okay. But again, I'm jumping all over the place here. So let's start high level. Okay. At high level, they were going to do 195 to 215 in EBITDA this year. Okay. Now we have to figure out how much of an EBITDA hit this facility is going to cause, one. And then two, as I've already started talking about, what's the likelihood that the rest of this business, the government business, the HHS business, is impacted in the future as a result of what Biden just did and what happened here? So there's two ways to figure out how much of a hit this will do in EBITDA. And I give props to my friend who found one of the two ways in the CoreCivic 10K. Okay, it's in the CXW 10K. They are the operator, or were the operator, of Dilly. And on page F16 of the 10K, you can see how much they pay in rent to Target Hospitality to run this facility. The number is $34 million. Okay? That does not include money they pay Target Hospitality for food services. So Target Hospitality does two things, gets paid two different ways: rent, and they provide food services to the facility. How do we figure out how much the food service revenue is? If you pull up the Q3 2020 earnings release from October 2020 from Target Hospitality, they tell you they signed a 5-year extension with CoreCivic and the government, and over the course of 5 years, it will bring in $265 million in revenue from CoreCivic. And it says, including some recent modifications, the total amount is $325 million, or $65 million a year. So we know the rent is $34 million, and we know the total is $65 million. So there's $30 million of food service revenue. That's the balance. That is, of course, not 100% EBITDA flow through. My guess is that's pretty low margin. It could be as low as like a 20% EBITDA margin. Okay? But we don't know the number. So on the low end, if it's a 20% EBITDA hit, if on the high end, it's a 50% margin of EBITDA, the food services contract, you get to somewhere between a 45 and 55 million EBITDA hit by them losing this contract. Okay? If your old number was 202.50, the midpoint of the 195 to 210, your new number is 157.50 to 167.50. Midpoint is 162.50. At $6.80, you have a 680 million market cap and something like 20 million or 30 million of net debt. Okay? Let's call it a 700 million EV. And your new EV to EBITDA multiple is 4.32 times. Now, this jives with a lot of other things, okay? The 65 million in revs, it's a $400 million revenue company. That's about 15% of the company's revenues. Guess how many beds are in Dilly? It's 15% of the beds company-wide. Okay? Now, the sponsor was willing to pay, and we know they were lowballing, and it was not the amount they were going to have to pay, $10.80 for Target Hospitality a month ago, 2 months ago. Okay? At $10.80, they were paying 5.43 times EV/EBITDA, the old EBITDA. Okay? And we know that was dramatically undervalued, right? We know they were going to pay up from that. I would guess as much as $13 a share. And there were some people that thought this was worth as much as $20 a share. By the way, they wouldn't be paying $13 a share if it was worth $13 a share. They're doing that to get themselves their 20 to 30% IRR when they flip this to somebody one day, okay? But stick with me. So they were going to pay 5.4 times EBITDA at 1080, which is not the price they were going to be able to pay. They would have had to pay $13, which would have been closer to 7 times EBITDA, okay? We're now paying 4.3 times EBITDA for the rest of the business that's much higher quality than Dilly because it was just signed, most of it was just signed in Q4, probably 100 million of the 150 million. That's RemainCo in the EBITDA. And it's a 10-year contract, 5 years plus an optional 5-year extension. And then, of course, they're 1-year renewals. So they can cancel after 1 year, okay? But we know that the government has a need for this facility. In fact, they have such a need that they're bidding for a second one or a third one at the end of this year, okay? They need a place to house the unaccompanied minors. It's by law. Okay, but that's not all. We're paying 4.3 times versus the 5.4 times, but we get the Dilly facility for free, empty, earning nothing. Okay, what is that facility worth? At least $100 million in CapEx. Is it worth $500 million? It was generating, you want to know how much money this facility was generating? Think about this for a second. Core Civic, the operator of the facility, made net income of $40 million annually from this. That's net, okay? If Target Hospitality is going to take a $50 million EBITDA hit, that means combined, they profited well over $100 million of EBITDA from this facility and this contract, okay? What's interesting is that going forward, Target Hospitality now works with a nonprofit to staff and run Pecos and other facilities, not Core Civic. Presumably, the nonprofit is not making money off of it, right? Though nonprofits still can make money by paying exorbitant salaries to their CEOs, et cetera, et cetera. But there's reason to believe that Target Hospitality, if they repurpose this facility and use it for the third bid, and they have their nonprofit run it, it could be run in a much more economical way than the cost that the government was being charged under the Core Civic and Target Hospitality partnership. Because there was $100 million of profitability there, not 50. And the nonprofit doesn't make that kind of money to be the partner of Target Hospitality. So we're paying 4.3 times versus 5.4 times, and we're getting this facility for free, okay? Let's talk about the risks of the 150 million of EBITDA that's remaining. Well, they can't cancel Pecos until November. It's an annual renewal. It's not a 60-day notice. And they just signed it last year. And I think I'm beating a dead horse here, but they need the facility. They need it by law. So I think the odds of RemainCo, Remain EBITDA, being impaired again is very low, okay? But what are the odds they can grow from here dramatically? This was a company that as recently as last quarter told you they had line of sight on 500 million in growth CapEx projects over the next 3 years, including that third bid, okay? And these are very high ROIC projects. Now that they have the Dilly facility idled, they don't even have to pay the CapEx there. They just have to reformat it, and potentially could bring in 50 to 100 million of EBITDA. Okay. Why didn't the company give us the earnings impact last night? They clearly know the number. This is not a hard thing to figure out. I just backed into it, right, from 2 different filings. So what would be the incentive or the reason for them not to give us the number? I can't see the general counsel of Target Hospitality hiding this number if it was some huge material number that the street had to be alerted to. let's say it was 100 million, 125 million of EBITDA, right? I can't see them green lighting that she's going to be okay with doing that. I also can't figure out why they wouldn't just disclose it. The closest thing I can come up with is two reasons. One of two reasons. One, they're trying to figure out if they can repurpose it in the short term to have a minimal impact. Or two, they're trying to figure out what this private equity firm is going to do with this company now. Because you can make a good case that they could still pay $10.80 for this. The growth opportunities are still there. You now have Dilly that's empty, that will probably be reused in the next 12 to 18 months, generating the same or more EBITDA that it was generating. And the private equity firm has the same problems they had before. They own 65% of the company. They're a UK-based or EU-based private equity firm. This is the only American position they have. They inherited the position. It's obviously a disgusting public company business that shouldn't be public, right? And they clearly still have an interest in taking this private. It's just at what price, and whether or not the special committee could even agree to something right now, given what just happened. But we're paying 4.3 times EBITDA, if my number's right, the $15 million in EBITDA hit. I think I covered everything. Now I'll take questions. Let's see what your questions are. Don't you think the deal will go through with a slight price cut, if any? I think that something like this happens and you really need to market test it. So they first have to come out and say what the impact is. They can't sign a deal without telling us what the financial impact is of this facility. So first we'll have to do that. Once they do that, one of two things are going to happen in the near term. We might get a 13D from the sponsor saying that they have pulled the 1080 bid. We might not. It's a very tricky situation because the sponsor's not going to come back and bid 9 and then agree to 11, right? And the sponsor can't buy this at 9. They won't sell them to them at 9, right? If 7 right now is the unaffected, that's a 24% premium. It's not enough. So I don't know how this plays out. Somebody I talked to yesterday thought that the sponsor and the company couldn't have been blindsided by this. They must have known for months that this was a possibility. Government doesn't move this fast. I'm pretty torn about that. I do think they were blindsided. I think this is all a result of Biden's executive order last week. The government was clearly trying to figure out what to do to implement his executive order. And this is what they came up with. And I'm not so sure that they gave the company any notice whatsoever. So I wouldn't bank on thinking that the company knew about this and the private equity firm knew about this when they made the bid. I think it's really unlikely. If you're the private equity firm, wouldn't you wait for the stock to blow up and then you place the bid so your unaffected is lower? It just doesn't make any sense to me. For all the Texans watching, Pecos, okay, Pecos, thank you. So GEO shouldn't be affected. What is GEO, CM? Is that the company? The prison operator? Yeah, GEO Group? Yeah. No, it's completely unrelated to GEO. GEO shouldn't be affected at all. It's a total one-off. It has nothing to do with the government trying to eliminate private prisons or private facilities for migrants. But doesn't this change the multiple for the entire company? How can you justify a 7-8 multiple of conscious, effectively short-term nature? It's a great question. So I think that the contract for Pecos is not a short-term in nature contract. And I think you have to believe that the facilities all can be repurposed and used for different things over the course of their life. So it was only it was never an 8 times EBITDA business. I thought they would pay 6.5 times EBITDA at 13. And that was because they had all sorts of growth embedded in the business. But you're right. Clearly, the market doesn't think this is a high multiple business anymore. But is it a 4.2 times EBITDA business with a giant facility that you're getting for free, not in that EBITDA? I don't think it is. What is the worst case downside for you? If they lose other contracts, it could be a 0. I mean, if they lost Pecos, I'm guessing the business only does 50 million of EBITDA after that, but I couldn't tell you the exact number. All they have left really is the HHS contract. But I mean, just go read the last transcript from these guys. Their pipeline, it seems to be booming with growth opportunities, both government and non-government. So, I don't get the feeling that this is a dying, melting ice cube business. I get the feeling that this was a one-off, very unfortunate thing that happened as a result of a political move Biden made to try to show that he's tough on the border. And there was no way for them to do it otherwise. And I don't think there's much risk, if any, of Pecos not being renewed in November. But people are saying right now what you're saying. This is a crappy business that can be canceled anytime. And why didn't the company give us the EBITDA hit in their press release? Glenn, PE business model needs a path to exit. It sure seems that path to exit requires go private first. I mean, this shouldn't be a public company. They could take it private. They could hold it for 2 or 3 more years through the election and through repurposing Dilly and other growth CapEx possibilities, and they could flip it to another sponsor at 6 or 7 times EBITDA, and it would be, much north of $9 or $10. It could be a business doing 250 or 300 million of EBITDA at that point. And they're already pregnant. They own 65% of the company. So this isn't a question of, maybe we should invest our money somewhere else. They need to figure out the best way to exit this position. And it's not doing secondaries in the public market. Interestingly enough, as I'm talking out loud to you all about this, come on, let's go. One thing that might happen here is the company puts out the new guidance, the private equity firm cancels the bid, and the company is very aggressive on their share repurchase. And then the private equity firm comes back again in 6 months or 9 months after they've shrunk a lot of the stock at $7 or $8 a share. I could definitely see that happening. I could see them canceling the bid and just buying back a ton of stock because that's in their best interest. They did it before this happened, and they'll probably do it again as soon as they can. I'm certain they can't do it now until they give the financial disclosure. And they might not be able to do it because they have the bid outstanding. So anyway. All right. Anything else on target hospitality? On position sizing, what are your thoughts on Kelly criteria type sizing? 5 up, 1 down is like my position at 60% rate. I size everything through my gut. It's mostly how much I'm willing to risk. And when I make positions really big, I don't think I'm ever going to lose more than 20% of my portfolio on them. A 20% loss in my portfolio is a 10% after-tax loss. And I'm comfortable with a 10% after-tax loss on based on the way that I invest. Now, mind you, if your portfolio goes to 0, there's no such thing as an after-tax loss. You just lost all your money. So, but that's just how I've always done it. One thing that I've done a lot over the years is once I get to a certain size in common, I try to focus on call spreads because then I have a fixed bet, kind of arbitrary, all or nothing, and I know how much I can lose. With this, I had a huge call spread position. I lost, oh gosh, I don't even know, 600 or 700 basis points on call spreads here. Now, mind you, they're October and they're January. So there's a chance that I still get paid on the January ones, especially if they win a new contract. The October ones are going to be tough. Can they be aggressive on the buyback now? Thought SSRM would do the same on the Turkish gold mine disaster, but they paused it. I know it's not quite the same. I mean, they're still generating 150 million a year in EBITDA, and they have almost no debt. And the private equity firms in control, they could be very aggressive. You know, it's a rounding error. They have no, I mean, they could lever up to 2x on 150 million and borrow 275 million here. And the 275 million would more than retire every share outstanding that the sponsor doesn't own. That's how cheap it is. There's only $700 million market cap, and the float is only 200 million. It's a $200 million float. They take the entire float out for 1.3 turns of EBITDA. You know, will they do that? No, they won't be able to buy it all. But I think that they would. Yeah. Thanks. What percentage of position are you normally putting in the common holding versus the call spreads? It's a good question. What I do is I try to figure out what the downside is in the stock, and that'll help me figure out how big I'll make a common. So with like EDR, I had no problem with that being a 50% common position because I thought the worst case scenario would be down 10 or 15%. With risky biotech, it could be down 50%, right? I also then look to see how great the proposition is for the call spreads. Am I getting 4x, 5x, or is it just going to double my money if the call spreads work? And I use all of that to try to come up with how much I'm willing to lose and where the better place for my risk is. So for practicality purposes, let's use TH as an example. So when TH was 1080, I made that 20% common position. And I had on these gigantic call spreads. And the call spreads, I was paying like $1.05 for October 10/12s and $1.25 and $1.30 for January 10/12/50s. So to put it another way, I was basically going to double my money on the call spreads if it was taken out. I thought there was no way it'd be below 12.50, or at least not below 12. And then with the common at 1080, it would have been like 10-15% up. And I thought before this Black Swan event that in the worst case scenario, it would go to $9 to $10 if they walked from their bid. So kind of like 2 down and 1 to 2 up. So it's kind of a similar proposition between common and the call spreads. But because the call spreads allowed me to make it so much bigger, it actually insulated me from losing more money today, right? My call spreads are now worthless or effectively worthless, and the stock fell 33%. When I thought it was only going to fall, to 9, it fell to 7. So I lost twice as much money as I thought I would lose in the common, 1080 to 7, or 1080, to 680 to make it simple. So I lost $4 in the common, and I was only going to make $1 to $2 in the deal. So the call spreads were a much better proposition in hindsight. On other stocks, I do it similarly. We could talk about BridgeBio as a good example. So I have a big BridgeBio position, BBIO. There's just like a lot of ways to skin a cat, With common, it's a risky biotech. If the ALNY data comes out in a few weeks, if it's the greatest thing since, sliced bread, then it could go to $20 or $22. I can't envision how it goes below that. But, that would be minus 25, minus 30%. If ALNY fails, I think BridgeBio can go to $40 to $50. And I'll walk you through that in a second. So for me, I'm positioned there across a ton of calls and call spreads and common, but most of my position is in calls and call spreads, just because I think that's the better proposition. But I also think it has very little downside. I think that $20 and $22 level is very unlikely to happen. So if I was not sizing things the way I size them, I would prefer to just be in common in BBIO, and I wouldn't want to waste money on premium for options because I believe in the margin of safety. Something like Unicor, can't really buy options there. It's mostly just common because the options are liquid, right? And with Unicor, there's $8 in net cash and it's a $5 stock. So in my mind, going into the catalyst that's coming in the next 6 weeks there, I look at $4 as my downside. So like I've been saying, I'm willing to lose 20, 25% there, which on the size of my position now would be well less than a 20% pre-tax P&L hit to my portfolio. We should talk about Unicor and BBIO because they have big catalysts coming up. And those are my three biggest positions coming in today, besides EDR, which doesn't move. I don't count that, is TH, BBIO, and QURE, right? BBIO is first with the catalyst, I think. So let's talk about this. First, they reported data in their phase 3 asset that competes with BioMarin last week, and the stock went down on that. I don't want to get into details with this, but I think that was well overdone and the wrong move. And I feel really confident that in phase 3, BBIO will show that they are superior to the BioMarin drug, though that won't read out until late 2025. It's not that important to the story now, but I just want to be clear that I think that the stock went in the wrong direction on that data. But the real main event for BBIO is the ALNY data that's coming the last week of June or the first week of July. It's likely coming the last week of June is my guess, okay? This is a competitor, of course, to the lead asset that BBIO has. That is the whole reason why we're here, the reason why it went up from last summer in ATTRCM. I spent a lot of time this weekend looking at the ALNY data from phase 2 and from their phase 3 trial in a similar drug. So ALNY tested this same mechanism of action already in a phase 3 trial, but it was dosed every 3 weeks. This is dosed every 3 months, but has a similar efficacy. So we know what a readout looked like at 12 months. It was only a 12-month trial from this mechanism of action. And what we found out was that there was no significant time of separation in those 12 months from mortality and cardiovascular hospitalizations, where BBIO had a time to first event at 3 months when the curve split, okay? And this is a very, very large trial. So I feel very confident that when they report these results, they will not show or beat that 3-month time of separation. Why does this matter? When somebody goes on one of these drugs, of course, the sooner it starts working for you and shows a clinical meaning of life efficacy, which is death and hospitalizations, it matters how fast that works. And if it takes 12 months for that to have an effect versus 3 months, it's gigantic in the clinic, okay? It's hard to overestimate how much BBIO can go up based on this ALNY data. ALNY is priced to move $5 billion up or down on this data. It's pricing in a $50 move, okay? BBIO is pricing in a $11 move on this data, which is like a $1.5 billion move, okay? This marketplace for this indication is somewhere between 10 and 20 billion. Right now, Pfizer has the only drug, and it does like $5 billion a year, okay? It's a blockbuster, growing gangbusters, okay? We know BridgeBio's drug is superior to it. no matter what anybody says in the peanut gallery, it is a superior drug. Whether or not they capture all of the market share from Pfizer because people don't feel the need to change, or what have you, or whether or not Pfizer's drug eventually goes generic in a few years, which is a huge issue for BridgeBio. That's another issue we could talk about later. That's beside the point. But this is a $10 to $20 billion market. The street only has BridgeBio doing 1 to 2 billion of that market currently, and they have ALNY doing 5 billion, and they have Pfizer doing 5+ billion. Okay. If ALNY comes out and their drug is equal or inferior to BridgeBio, I believe BridgeBio will add at least 1 billion, if not 2 or 3 billion in peak sales to people's estimates. And the multiple you put on that is 4 to 5 times, which means that there's a chance that BridgeBio could go up $25 or more on this event. Versus, I believe that the entire business is worth low to mid 20s minimum without this drug being valued at anything, given how I think the 3 lead phase 3 assets combined will do over $2 billion in sales and are very likely to be approved and be successful. There's 2 different things that we're going to learn when ALNY reads out. One, we're going to find that how good it does as a monotherapy, and one, we're going to find out how it does as a combo therapy with Pfizer. Okay. If it doesn't significantly beat in combo and it just matches, BridgeBio is going to go through the roof. And my belief in that is that almost proves that the BridgeBio drug is superior to the Pfizer drug, because it can't beat even when you layer on a silencer with a stabilizer. Okay. Now, if the monotherapy doesn't beat, they don't even have a market there. Okay, it's a once in a quarter infusion versus twice a day pill, and it's more expensive than BridgeBio's drug. The combo therapy is more than double the price of BridgeBio's drug. So in order for payers to go that route, they would have to see a significant improvement in those dual endpoints of mortality and cardiovascular events, hospitalizations. If you look at what BridgeBio put up at 30 months, it's very hard to put up better numbers than that. You could see what they have put up versus what a healthy adult or senior citizen would do if they didn't have this disease. It's a very minor difference at this point. The BridgeBio drug almost effectively cured the disease. You then have to ask yourself, why did the company push back the data release by 3 months to where they now are going to be reading out 33 to 36 month data, not 30 to 33 month data? They didn't do this because they were super bullish on what they were seeing in the blinded data. Most likely, they saw something in the event rate. And maybe the event rates were too low. Now you would think, oh, too low event rates. That means everybody's living. They chose a healthier population than the BridgeBio trial. And there's a chance that the event rates are so low because of the population they selected. This will also make it harder to show real separation and differentiation at the endpoint. You need events to happen to show that your drug is working. If events are too slow, then, or not enough, then it's harder to prove that your drug is so much superior to another drug that had events happen on both the placebo arm and the drug arm. So I am very bullish on the BridgeBio readout. I think that it's like I said, a $3 to $5 down, $25 up scenario. Could it go to 20 or 22.50? It could. It would take just the most phenomenal data set for that to happen. And even then, I think BridgeBio would have a market, by the way. Let's say that the data set where they crushed it was in combo, not in monotherapy. Well, guess what? They could prescribe the BridgeBio drug with the silencer as well. It's just a combo stabilizer and silencer. If the BridgeBio drug is better than the Pfizer drug, you would use that in your combo therapy. The only way you get completely annihilated here is the monotherapy absolutely destroys it. And I think even in that outcome, the silencers don't capture more than 50% of the market share because people prefer a pill to infusions. And in that scenario where ALNY gets 50% of the market, they'll get 6 or 7, 8 billion of the market, and the rest will go to the stabilizers. And BridgeBio has the best stabilizer. It will still be a multi-billion-dollar drug. This is a clearing event. This is the clearing event. And people are terrified of it. So yeah, I like BridgeBio a lot. I think it's an incredible setup going into this, not without its risk. Okay, people expect the ALNY data to be successful. I expect it to be successful, to read out with a positive p-value. That is not the issue here. They need to show superiority at 30 months, not 33 to 36 months. And I'm just not sure they will do it. Now let's talk Unicor. Unicor has 2 major events happening in the next 6 weeks. 3 events, I guess. One, they're going to announce their Huntington's data, their 6-month update. 2, they're going to announce an operational update where they did an operational review they announced last quarter, and they're going to finish it mid-year. And then 3, they're going to tell us what the FDA said, some element of what the FDA said about their meeting with Huntington's. So since we last spoke, they were given the equivalent of breakthrough designation, RMAT, I think it is, RMAT. And that's great, but it really doesn't mean much. All that means is that the FDA saw signs of efficacy in the trial, and they're hopeful that the drug will be successful in the future. It does not mean the FDA thinks the drug certainly works, and it does not mean they're going to give them an accelerated approval or any form of it, okay? It's kind of a way to appease advocacy groups, to say, look, we care. This is an important indication, and we care about this drug. Now, it's better than them not giving them the designation, right? If they think that the whole thing was hocus pocus and the matching of the placebo, the matching of the natural history was bullshit, then they're not going to give them the designation. They're going to say, you guys are playing funny with natural history, and we're not going to play along. So it's not nothing that they gave them that designation. And it was nice to see, but it doesn't really mean too much. What's way more interesting to me is what happens at this data release, which I expect in the first half of July. It's probably not coming at the end of June because they used to say second quarter or June, and now they're saying mid-year. So I'm guessing for some reason it's coming in the first half of July, and maybe it's coming the same time when they give us the operational review. I've talked about this many times already, okay, so I won't be too long, but I think there is a decent chance that the data shows stability from 6 months ago, or relative stability. If it does that, I think the stock goes up a lot. What's a lot? $2, $3, $4? I don't know, okay? I think there's an okay chance that they give us some feedback from the FDA that shows that they're encouraged by a phase 3 trial that could match the natural history or something like that, okay? And finally, I think there's a very good chance that they do something strategically on the cost side or better when they announce the conclusion of their operational review. I don't know what that will be. It's very unlikely to be a sale. It's very unlikely to be a partnership. But I do think that this data release and the FDA feedback will go a long way to them finding a partner for Huntington's or a sale of the whole company. If they do partner Huntington's, I think the stock could double. But I think that could be 6 months or more away. Okay. But what's the downside here? So they come out, the Huntington's data shows a huge decline. Okay. They do the strategic review, and it's underwhelming. They don't cut enough costs. And finally, for the trifecta, the FDA says we require a randomly controlled trial, an RCT, for you to ever get Huntington's approved. It's $8 a share in net cash. I assume it goes to $4. $3.50 to $4. And then you have to ask yourself, what does the company do? Right? What do? They have 3 other assets that are entering the clinic. The epilepsy asset is the most important one. They'll probably shut down Huntington's if that's what happens, if there's a huge market decline, and the FDA says you can't run a matched natural history trial. And they're even in a harder place than they were before. I would be hopeful that they would try to sell the company for cash for the 3 assets. But I don't think that's a likely outcome. So I like the setup a lot in Unicor going into the next 3 weeks. For full disclosure, I had to sell some Unicor today, and I had to sell some BridgeBio today for my margin call this morning. And I'll probably still sell a little bit of it over the next 2 weeks, but less than 20% of my position, and the positions are huge. So my Unicor position is like 60% of my portfolio, and my BridgeBio position is like 35% of my portfolio, delta adjusted, mostly options. I'm exhausted. I'm really glad I did this though. And I appreciate you guys all coming out. And I want to reiterate that the BridgeBio and the Unicor readouts are very risky. And BridgeBio absolutely could go down a bunch on this readout. And it should be, understood that I am in no way saying that this is a sure thing. That there is no such thing as a sure thing. I thought Target Hospitality was the closest thing to a sure thing, and they had their contract canceled after having it for 10 years. I mean, they literally just need to keep this contract for another 6 weeks probably, and this deal would be signed. It's just atrocious luck. Please turn Vouse 12 back on for your Twitter feed. Oh yeah, Michael, I'll add you back. Let me see if I can find you. All right, guys. Onward and upward, okay? Oh, and I still own JWN. I love the Nordstrom position still, though I don't like it necessarily owning common. I like it in my complex option position. So I definitely wouldn't advocate owning Nordstrom common here. I don't even know how you put on what I have on now. So it's kind of irrelevant, but I like Nordstrom the way I own it. Thank you, guys. Thanks, everybody, for the support. All right. I'll definitely speak to you after Unicor and BridgeBio reads out, one way or the other. Okay? All right. Take care. Bye.